in the planning stage of the audit and the risk assessment phase. And so specifically, we're looking at fraud risk assessment. So let me ask you a question. How many of you think it's the auditor's responsibility to find fraud? Why or not? So by you not raising your hand, does that mean you don't think it's the auditor's responsibility?
I would think it's the responsibility to report it if it's found.
Okay. So that's different from refining it, right? Then what are you going to say?
I think it's a little bit, I feel like it's too much of a burden to put on a team for the fact that, let's say, these people, they know their systems super well. They know a lot more than we do. So for them to hide something is, I guess, much easier than for us to uncover it.
What are we going to say?
Audits are only good when financial statements straight. But it doesn't cover anything else. Like the responsibility for fraud should be on the executive, and that should be like pertaining to like straighten out the and they make management to review the statement, sign off on it, say anything, review it, and don't have to discover anything. So that the responsibility.
Right, so basically your conclusion is that it's not the auditor's responsibility. The auditor doesn't audit to find fraud, right? Is that the general conclusion? Well, how many of you believe that's what the public perception is? What do you think the public? So you're sitting in you're accounting majors, and you're sitting in an auditing class, you have a little bit more knowledge than the general public.
I feel like the public paying auditors by association is involved in any fraud discovery.
So you think the public thinks the auditors are culpable? Why though? Because they don't, it's management's financial statements. Why do you think the public believes that?
They have like a different, very different notion. It's like hijacking.
No, you're the only people talk to this. Right, because they believe that there are different reasons. One is the fact that the company pays the auditor. Casey will
I would
say.
say that, well, like they have a very different notion of what assurance is.
Right.
Like they believe you give
Absolute assurance, right. Right, they have different expectations about what the auditor actually does, and that's what we call the expectations gap. So there's this thought that auditors actually do more, and by auditing the financial statements, that auditors should uncover fraud. They believe that it's the auditor's responsibility, that if the auditor didn't, if they didn't find the fraud, then they didn't do a good job. So that's a general perception. And so that's why you see in the financial statements, especially, in the audit report, where the auditor, the wording is very specific about what auditors do, right? That they provide reasonable assurance that the financial statements are free of material misstatements. And they talk about the fact that they look at estimates, they take samples, and so on and so on. So it's trying to close this expectation gap about what auditors actually are providing assurance about. So with respect to the auditor's responsibilities for fraud, it's the auditor's responsibility to assess the risk of fraud. So in other words, examine the financial statements and assess the risk of where what accounts are most susceptible, what types of transactions are most susceptible to fraud, and then assess what kind of controls the client have in place, what kind of environment is in place that would mitigate that. And if the auditor determines that there's a higher risk of fraud, that doesn't mean that there's fraud. What that means is that the auditor is going to adjust their audit procedures to address that risk. So similar to when we talk about the audit risk model, and the auditor assesses the risk of material misstatement, a part of that is whether that material misstatement is due to error or fraud. And so adjust their audit procedures to that. So that's what SAS 99 covers, assessing the risk of fraud. So the auditor's responsibility with respect to fraud. So the auditor, we talked about this before, the importance of professional skepticism, and I pointed out that professional skepticism is written throughout the various standards. And so there's no standard on professional skepticism, but as in an example, it's written into the various standards. And so in SAS 99, it talks about the fact that auditors should exercise this professional skepticism. And it provides the auditor, so the overall objective of SAS 99 is to provide the auditor with guidance regarding assessing fraud risk. What are some of the factors they should look for? What are some of the conditions that generally that are suggestive of fraud risk? Clearly, if you have poor internal controls, that increases the risk of fraud. So again, auditors, you can't walk in and say, oh, my client is guilty, or they're not honest. So, but they're not supposed to assume that they are honest, right? Have a questioning mind, critically review the evidence. So, as we talked about professional skepticism. So in a nutshell, and I have on Blackboard, I placed the primer on SAS 99. So I think it's what every student should know about SAS 99. So it provides some really good details about SAS 99 in terms of what the auditor's responsibilities are with respect to fraud risk assessment. But in summary, SAS 99 again provides guidance for the auditors with respect to fraud risk assessment. And one of the things that SAS 99 suggests is that the audit team get together and brainstorm. So why do you think that's important? And who's the audit team? Who should be involved in those meetings? What do you think? How many of you some of you interned, right? No? Have you ever been in a brainstorming session? Can you tell us a little bit about it?
Typically the partner that would lead the brainstorming session, and if there were people, basically everybody involved would have to participate, even if they were abroad, they would do some sort of teleconference or something. And the partner basically, at least with us, they had literally a PowerPoint presentation up with, and then he would kind of give some disclosures in the beginning to kind of explain how you have to make sure you're independent and this and this and that. And then the manager would typically chime in as well, but it was typically them two that were talking the most.
Okay.
More upper level.
So was it more like a planning session where you then talked about a number of things and then fraud? Probably one factor that you talked about. Is that true? Case? Or was it specifically for fraud?
No. It was a planning meeting for the following audit.
Right. Right. And so, and that's typically how fraud is discussed. We did a study a while back, or someone did a study a while back. Someone did a study a while back when soon after SAS 99 was issued, and trying to determine how many firms or audit teams actually engaged in this brainstorming session around fraud risk factors. And the number was very low, right, in terms of how they do it, and even if they did do it, very few audit teams included the complete audit team, the entire audit team. The objective that the standard setters had with respect to brainstorming is to make everyone on the engagement team aware of those areas that were most susceptible to fraud. So in other words, where they're the highest fraud risk or the highest probability of fraud. And also, importantly, information sharing, like a transfer of information. Because the audit team members of the audit team work on different areas of the audit. Right? So if you can imagine that if you are working on controls, that you're responsible for test of internal controls in the revenue cycle, well, there's going to be information that you have about that might, together with information that someone else has, right, on the audit team that might indicate there's a higher risk of fraud, right? Or there's something, some anomaly in the information that would suggest that there's a problem that would raise a red flag. So it's, and also for newer people on the audit team, is to try to help them think through where fraud could occur and what factors generally give rise to a higher risk of fraud. So it's learning, right? It's information gathering and learning for newer people on the audit engagement so that they're more aware, to increase their professional skepticism. Right? And so that's the importance of having this brainstorming session, is so that all audit members, or all audit team members are making a contribution and learning from one another. Because what you don't want to happen is that after everyone's turned in their work and the manager is reviewing, and something comes up that looks kind of, you know, as a red flag, and you're now at the tail end of the audit, right? And so you don't have enough time to, or you spring this on the client at the last minute. Okay, so that's one of the things that SAS 99 suggests. But essentially what the conversation or the discussion should entail is how and where they believe that the entity financial statements can be susceptible to fraud, how management could perpetrate that fraud, and then conceal that fraud. So for example, if you have, let's say you have an environment where there's a high risk of material misstatement because there's high inherent risk and controls are not very effective in a particular area. So let's say segregation of duties in the disbursement cycle is lax, right? It's not very effective. Well, that and then let's say from an inherent risk factor, it's a culture where people are disgruntled with the company, they feel overworked, they don't have there's no statement of ethics and no real internal controls, standard internal controls that is communicated to everyone. So it creates a higher inherent risk. So that might be a situation where someone could basically steal and conceal it, misappropriate assets. Right? They could steal cash, they could generate fictitious invoices, pay those invoices, send it, and take company cash, misappropriate assets, because the controls aren't there. And it's an environment that is that has higher risk because of the culture. Right? So when you think about things like that, in terms of management fraud, things such as, is it a very complex environment? Do they have a lot of subjective transactions? Does management present an environment where they are very, they overrule everything, right? That they lead by fear and intimidation. Like look at Wells Fargo as an example. I'm not saying that management led by intimidation, but clearly there was an environment that suggested meet the numbers, make numbers, grow revenue at whatever the cost. Right? We expect you to do it, and look at what happened. Right? So again, how might management perpetrate and conceal? How might someone misappropriate assets? And then how are you, as the auditor, how is the audit team going to respond to those areas? What type of tests would they do? So in a situation where where I just described a high risk of material misstatement, what's the auditor going to do? Gather more evidence, right? So if they have a situation where disbursements, when I talk about there are no controls over disbursements, what evidence are they going to get? What are they going to do? They're going to test controls? More controls?
Try to get documentation from the third party directly.
Right, so they might confirm accounts payable. But the problem with that though, right, is that if you have fictitious accounts payable because you're collecting the money, then it's not going to be an accounts payable balance when the auditor comes in. What they're looking for is disbursements. So they're going to look at transactions that gave rise to those disbursements. So they might look at vendor invoices. They could, contact the vendor and say, we have, they could confirm the vendor that this invoice was actually issued by the vendor. They might do that, right? Because they're trying to determine, they'll look at the vendor master file, test the vendor master file to ensure it's a valid vendor. Right? Examine, so they're going to look at more transactions because they can't rely on the internal control. So they're not going to test internal controls, at least over that area, and look at more detailed transactions, more documentation to support the actual transaction. But an auditor, again, has to know this, right? They have to, in the planning stage, be able to identify this so that they can set their audit procedures, establish the audit procedures they're going to use. In addition to how the auditors identify where the financial statements were susceptible to fraud, in addition to those procedures, they're going to also inquire about it. So, you know, it's not as easy as saying you go to your client, are you committing fraud? No. Right? You talk to them about situations. Have there been any situations where they have a concern, for example, that there's been inappropriate transactions or fraudulent transactions? What kind of procedures do they have in place to address that, to ensure that controls are being adhered to on a timely basis? For instance, if you have an internal audit department, what's the internal audit department's work plan? Where do their reports go once they've completed an audit? How are those, any deficiencies they identify, how are those resolved? How are people dealt with who are repeat offenders, for example, who just don't adhere to the controls over time? What kind of pressures? The auditor also wants to look at what kind of incentives and pressures management have. And we'll talk about the floor triangle in a moment. Right? Because if you have incentives or pressures, again, Wells Fargo, this is current policy, right? There were clearly pressures to make numbers, and then people were paid, right? They were given bonuses or commissions to do so, right? So that created an environment that was right for fraudulent transactions. And the other thing, remember, we talked about analytical procedures during the planning stage. What's the objective of analytical procedures during the planning phase? Why are the auditors performing? Why is it required? What's the objective? Yes.
Basically, they have kind of like point emphasis, like a reference point, so they know exactly what information to compare.
So, but why are you comparing the information? What's the objective of doing that?
Basically to find out what part of the audit engagement they need to focus more on.
It's attention directing. That's it. That's the objective of, that's all you can say in the planning stage, right? Because when you think about what analytical procedures are, they just tell you that something's changed, right? The relationship is not what I expect it to be. It's not moving in the right direction. Or if you're doing ratio analysis, the numbers have gone up. Days outstanding in accounts receivable have gone up, and right? You don't know why. That's the only thing it can tell you in the planning stage is to direct your attention to a potential problem. Then you have to adjust your audit procedures to address that problem. about how auditors gather fraud information to assess fraud risk, think back to when we talked about the planning process, understanding the entity. Right? That's the information that auditors gather. When auditors are gathering information about understanding the client's entity, understanding the industry in which they operate, the transactions that they engage in, changes in the economic environment that could impact the client, all of that information that they're gathering, right? They're gathering that to assess risk, of which fraud risk is one of them. The types of risk they assess. So communication amongst the audit team, the brainstorming, inquiries of management about changes, about what, different, inquiring about fraud, inquiring about, different changes in their business strategy or objectives. Identifying the risk factors through their own assessment of risk, right? The risk of material in the statement, the inherent risk factors and the control risk factors. As I said before, analytical procedures and and any additional information that they have, they use to identify where in the financial statements there's higher susceptibility to fraud. So again, there's all of this information the auditors gathering as they capture information, as they go through the planning process and gathering information about understanding the client. So what's the difference between, do you think, between management fraud and a misappropriation of assets? Are they both frauds? What's different about them? Yes.
I think one is intentional because misappropriation could be budget or
That would be an error, right? So there's a difference between error and a fraud. So a fraud is intentional, and error is a mistake. You made an honest mistake. So what's a misappropriation of asset? Just by its definition, what does that suggest to you? If you misappropriate them, you just described what? Misappropriation means what? Theft, right? So in one case, you steal assets, cash, inventory. In the other example, you understate, you manipulate your accounts because your objective is to overstate revenue, for example, or to manage your earnings. How many of you have heard that terminology for managing earnings? Right? So you think about what do you think the objective was with Enron? Why were they doing what they were doing? Sorry? Overstate earnings. That's managing your earnings. Most times companies are trying to manage earnings upward, but could be a case to be made that they might try to manage it downward because they're trying to manage expectations. So given that, what do you think the right answer is here? Sorry? B. Right. Because with management fraud, you're trying to mislead the public. When you manage your earnings, you're trying to mislead, right? And the challenge with managing earnings this way, right, is that you're managing earnings through exploiting the flexibility or the subjectivity in GAAP. And so as a result, this makes this type of fraud is very difficult to detect. Or even, imagine if a client is operating within the bounds of GAAP, right, it becomes more difficult for the auditor to challenge the client. Not that they can't, but it is. It creates more difficulty because it's more subjective and it's more judgmental. And so when you see that if clients are going to try to manage those earnings, they're going to try to manage those earnings by exploiting GAAP. So for example, it's reporting a lower allowance without accounts, right? Because if you report a lower allowance without is a common framework in assessing the risk of fraud or assessing the likelihood of fraud. So if you have these situations where there's incentives, there's opportunities, there's attitudes of rationalization, then that increases the risk of fraud, right? Not that a fraud occurred, but it increases the risk, what we're talking about. So incentives and pressures are those situations where employees or management feel this need, right? In terms of pressure to overstate numbers or have incentives to overstate numbers or manage earnings, right? Or someone has an incentive to steal, right? So if you look at that, and then as an auditor, so things like when we talk about inherent risk, we talk about, is it a publicly held company? How closely are they followed by analysts? Does management have the kind of mindset, right, or culture where they are very, very concerned about meeting or beating analysts' expectations, right? Is management paid by, are their earnings tied, their compensation tied to earnings? And so that, in order to look and say, well, there are incentives there, and there are pressures there. If the tone at the top is to make numbers at all costs, we cannot miss analyst forecasts, so that they constantly drill this down into their employees. So in order to then look at that, well, then what kind of opportunity? So that would increase inherent risk. Well, do they have the opportunity to do it? To give into those incentives and pressures? Or you can have incentives and pressures, but then how does it end? Or do you have a system in place that would prevent it, or that would allow that type of, you to act on those incentives and pressures? And so things that they look at would be, what kind of oversight is there over the financial reporting process, right? If it's a publicly held company, they're required to have an audit committee. Well, how effective is the audit committee? Are there an audit committee informed, meaning they meet all of the requirements as set out by the standard setters, the regulators? Or are they an audit committee of substance, where they actually take their responsibilities serious? So they're challenging not only management, but they're challenging the auditors. They have meaningful discussions when they actually meet. They understand what the issues are. So what kind of oversight are they, and what about management? Is there proper oversight at the top? Then significant accounting estimates, right? Do they have situations where they have a lot of accounting estimates that are highly judgmental, right? And they're significant. So, example, is fair value measurement. Do they have level 2 and level 3 assets, which makes measurement, fair value measurement, more difficult? Do they have do they have goodwill? So there's always this impairment of assets that the auditor has to be concerned about, estimating that, the fair value of those assets. And then one of the bigger things is internal controls. Are internal controls effective? What's the definition of internal control? What's the definition of an effective internal control system? What's internal control, basically? Let's just go. So a system in place that you're on the right track. Well, what is it by management specifically? Right, so it's management system of internal controls to prevent, an effective system is one that prevents or detects on a timely basis material misstatements from entering the system. Because realistically, if your internal controls are not effective, you don't have internal controls. Right? There's no control if it's ineffective. Right? So you want to examine whether or not the internal controls are effective. Right? But if you have ineffective internal controls, that creates opportunities. And so that's going to increase the risk of fraud. And then attitudes and organization is what's the corporate culture? What's the attitude of employees? So if you take employees who are, you know, disgruntled, you know, they feel like we're the 1% is getting everything. Did you see the Wells Fargo CEO before he stepped down? He still has his, I think, over $40 million to walk away from the company. And 5,300 employees, lower level employees, were fired. What kind of sentiment does that send, do you think, to the remaining employees at Wells Fargo? Right, right, and if you're high enough on the food chain, right, it doesn't matter. You can get fired, go before Congress, and be skewered by Elizabeth Warren, right, and still, finally you lose your job, but you get paid. You get paid more than anybody is possibly going to make. Than all the people who were fired combined, all the years they worked, it did not add up to $42 million, right? Or whatever his number was, it was high, right? So that can create really bad attitudes in the company or feelings in the company of lower level employees who feel like, what the heck, you know? So look at those kinds of things. Like what's the morale at the company? You know, does the company have a code of ethics or a code of conduct, expectations, that people know what's important? How many people think fudging on a T&E okay? Right? That, you know, you have an extra receipt, so you throw it in there. And you say you ate, you know, at a bar restaurant, but you actually ate at McDonald's. It doesn't qualify as a bar restaurant. How many people think it's minor, it's immaterial, so it's not a big deal? They can afford it. Of course, you want to think that, but, right? I'm not asking you, it's just rhetorical, right? So there are things like that. That's a theft of assets. You're misappropriating assets. So some companies have a zero tolerance for T&E abuses. Denise was going to go over a problem when she was here on IDEA, where it's the P cards, where we used in this particular company, the employees were given company credit cards, which they call purchase cards. And they monitored the abuses of those cards, and they had a zero policy because those cards were only supposed to be used for business purposes. So in other words, if an employee went to Walmart and they were picking up some stuff for, you know, the office, they couldn't add something in there and say, oh, I left my card home, so I'll just add this in. No, they monitored that. They had a zero mindset. So that's a company that, you know, look, we have a zero tolerance for any kind of behavior or actions that go against the company's guidelines and standards. So some examples, attitudes of rationalization. As I said, management has a history of overly aggressive reporting. There's an inefficient or inappropriate communication environment. There's a disregard in general for internal controls. If at the top management is overriding controls, then probably, you know, the employees are not going to think it's that important. And so when you have these three types of factors, that increases, and certainly all three of them will increase significantly the risk of fraud. Any questions on it? So I talked about this already. I'll just quickly say, management, two types of fraud. They're both fraud. They're both intentional. Management fraud is used within the bounds to manage earnings, to overstate possibly net income or understate, depending on what the objectives or the incentives are. And misappropriation asset deals with the theft of the company's assets, right, such as cash or inventory. Usually management fraud is committed at a much higher level, right, because it's going to be committed by those individuals who have responsibility for the financial reporting process. And usually employees examples of risk factors, I'm not going to go through all of them, that you see with respect to management fraud. There's a motivation to report fraudulently because it could be based on incentives to meet pressures to meet forecasts. Management is dominated by one individual, so that person puts a lot of pressure on people. They don't have a good attitude about internal controls. You see that management tends to override internal controls. Again, I talked about the idea of being very aggressive in their reporting, or placing too much emphasis on meeting analyst forecasts. So another thing that's a little less obvious would be things such as if there's a high turnover. Right? So it could be a high turnover because people just are not interested, they're leaving the company to pursue other opportunities. But especially if it's in an accounting area, right? It's possible that people are not comfortable with some of the things that management is doing, or they're being asked to do, so they leave the company, or they're being fired because they're not willing to do that. If you know that the company has a history of violations, so these are just some examples of that would lead the auditor to assess fraud risk potentially higher, or at least identify that there are incentives or there's a tone in the organization that would suggest that there is more susceptible to management fraud. Other things would be industry conditions or operating conditions, and some of these we talked about when we talked about inherent risk. A lot of them actually did when we talked about how auditors assess inherent risk. So what if the company lags behind its competitors with respect to profits, right? So one of the things that you do in your analytical procedures in the planning phase is that's why you look at what the company is doing as compared to its competitors, right? As compared to other companies in the industry. The company might be in a highly competitive environment, right? So they're losing market share. The company could be in a situation or in an industry that's rapidly changing, and so their products are not they're not keeping up with the trend in products or the changes in products. This is why software companies, right? Electronics companies, how many times does iPhone come out with a new phone? Like every year it seems like. Or a new iPad, a new iPhone, or something like that. So look at, now you finally have companies catching up, and then what's going to happen with Samsung now that they have exploding phones? Right? So again, you look at where is the company in response to what's going on in the industry, how are they keeping up with product changes. In terms of operating conditions, that we talked about already, weak internal controls, ineffective internal controls. They have very difficult accounting measurements. So you can imagine that a company that has a lot of financial instruments that are not level 1, meaning that they are harder to measure the fair value, that makes it more difficult, right? Because that creates an opportunity, an environment. If management wants to manage earnings, they can do it within the bounds of GAAP, or try to anyway. And again, that's another example where those types of transactions are also very difficult for the auditor to audit, because if you have a level 2 or level 3 transaction instrument, it's harder to determine what the fair value is. And then we saw with Enron, right, a lot of related party transactions or inexperienced accounting personnel. I'm not going to go over all of these, but just to say that employee fraud again is usually misappropriation of assets, where you're stealing companies' assets and trying to cover it up. I'm not going to go into each of these. Embezzlement should be aware of. An error, as I said before, is an unintentional misstatement. Unlike management fraud, right, which is trying to misrepresent your financial statements. Employee fraud, right, or misappropriation of assets is not as obvious. And here's some of the reasons why. I think most people can pick out several of these. And it says it applies to you, especially during midterms and exams and things like that, right? Not the drug. Fluffy is not. So imagine if you're an auditor and you're out at a client and you're in. How do you know that somebody, because they're yawning when you're in their office asking them questions? How do you know? I mean, they might just be tired because it's year end and they're working late at night to try to get the financial statements or give you the information that you requested, that they can't relax. Well, you're an auditor. Some people just don't feel comfortable around an auditor. Right? So there are a lot of things. So this is a lot more difficult, right? To determine. Are you not going to know that as an auditor, you're just not trained to spot these types of behaviors in audit and you say, okay, that's indicative of law. Right? So these are hard by definition to identify misappropriation of assets or employees. There's some other characteristics of fraudsters. They're executives, so they're making a lot of money. Why would they do that? They have no. This person is in a management level position. They get bonuses. Why would they misappropriate assets? Why would they do that? They don't need the money. Well, you don't know that, right? Because you don't know what kind of debt people and people do things for the strangest reasons, right? Because it's personal to them. I remember attending. Price Waterhouse used to have, I think they still do it, I'm not sure. They have what they call PwC University. And so they invite faculty, accounting faculty to come in for a couple of days and they present to us different things that PwC is doing in terms of their training, things that we can bring back to the classroom. And one of the segments was a meeting with the people a presentation by the people in their forensic auditing division or area. And I remember the guy that was doing it, by the way, he wasn't a CPA. This guy was from the FBI. I think he had a background in FBI, the CIA, or something like that. He was an attorney. And so what they did, what he said was he had this case where the company, that he was brought in because a company suspected that there was fraudulent activity going on, and they wanted the firm to investigate it. So they were hired to do a forensic audit. And what he said was, eventually, they have all these techniques that they use. And it turned out that the person who was stealing the money was the owner's daughter. And, and she was in a high level position. She was in a management level position. And when they figured it out and they sat her down and they talked to her about, well, why would you do this? You're the owner, you're father owns the company. This is your family's company, so you're, basically stealing from yourself. And her reasoning was because she was angry with her father. She was angry with her father because she wanted to go into the arts. When she went to college, she wanted to get a degree in, art history or something. I don't know, but he made her go into business. He made her get a business degree, and then she had to come and work for the company, and she didn't want to do that, so she was angry with him. So she saw that as a way of punishing her father by stealing money. So that's, again, so you might look at that person and like, oh, well, this is one of the owners, this is the family's business, so why would they steal? People have the strangest reasons for why they do something. It's not always logical. But again, this is just to really point out that, you don't know. Like, you have no idea by looking at someone who's a fraudster. The thing that you can control, right, or look out for is evidence, the evidence that you gather. So look for exceptions to documentation. What doesn't make sense? Again, being professionally skeptical. So if you see missing documents. So one of the standard things that you can perform in IDEA is to do, a search for missing documents to make sure that everything's complete. Right. So if shipping documents for the year fall within the range of 1 to 200, you can do a search to make sure that run a program or script to make sure that nothing's missing, or by day, right? If you know the total number of shipping transactions. Alterations on documents, this is a little more difficult, right? Because if someone's going to try to reproduce a document or change something, you can scan now and then doctor it on your computer. So technology of word processing capabilities now makes it a little bit more difficult. Also to detect photocopy documents, for example. So these are just some examples. Other things you look for: outstanding checks. When you old outstanding checks, we do a bank reconciliation, we'll talk about cash, auditing cash, we'll talk about that more. You look for, you investigate those checks that have been outstanding for a long period of time. Because checks clear really quickly. It's unusual to have a check outstanding for more than a couple of days. Or certainly not more than a week. Most people get a check they're cashing. You want to look for duplicate payments. These are a lot of these tests you can perform in IDEA. If there's any inventory shortages, right, that could be indicative of someone stealing inventory. Customer complaints. What are the nature of the customer complaint? Right, the customer is constantly complaining that they're being billed for goods that they never ordered or never received. That could suggest that somebody is falsifying shipping documents. Right? So that they're claiming that they're shipping the goods to a customer, but instead they're stealing the goods themselves. They're stealing the inventory. So these are just some, and again, increased past due receivables would also point to something like that. Because obviously the customer, so even if the customer doesn't complain, if they can order something, they're not paying for it. Some things that the auditor should kind of assume is that revenue recognition is a fraud, right? Higher fraud risk for improper revenue recognition. So that's not to, again, not to say that fraud exists, but you presume that, and revenue is risky. So auditors always focus on revenue and look at that to be more of a risk. You want to identify what's the risk that management is more likely to override controls. So you look at journal entries, right? For example, in the general ledger is where the accounts are summarized, basically. So most of the entries that are hitting the general ledger are probably hitting on a monthly basis. So you're not going to see a lot of journal entries, or you shouldn't see a lot of journal entries posted to the general ledger account, depending on the nature of the account. That's not coming from some type of sale journal or master file, right? So for example, revenue, you have a sales journal. It's on a monthly basis. The monthly total is recorded as a credit to the revenue account in the general ledger, and then a debit to the accounts receivable account in the general ledger. So you shouldn't see a lot of activity flowing through the general ledger. Same thing with cash. Right? The cash account in the general ledger, you're going to see the debit coming from the cash receipts journal, the credit coming from the cash disbursements journal. So you shouldn't see, other than seeing those monthly journal entries, there shouldn't be a lot of journal entries or topside journal entries going through the general ledger. So it's kind of easy to scan the general ledger or on a scripted idea to identify journal entries that are flowing through certain accounts that are not coming from a sales journal. I'm sorry, a supporting journal. Other things is recognize that when clients have a lot of estimates or subjective estimates, judgments such as the allowance for doubtful accounts, the obsolescence reserve, warranty reserve, things of that nature, and determine whether or not there's an incentive for the client to bias those numbers down. Because by biasing those numbers down, we can reduce the expense. By reducing the expense, you increase net income. It's important to understand what's the company's normal operating procedures. So what kinds of transactions do they normally engage in? What type of business is it? Because you want to be able to identify, are there any significant transactions that fall outside of their normal business process? And then using that, identify what the significant risks are. Some things that you want to be concerned with or that are be concerned about with respect to revenue would be obviously fictitious revenues. So reporting revenues for goods that have not shipped. So occurrence, and it's not valid. Or recording revenue to shipments made to fictitious customers. If it's a fake customer, it's not a valid shipment. It's not valid revenue. Premature revenue recognition. So that revenue is recorded in the wrong period. Or let's say you sell magazines, right? So you sell by subscription. The way that you would normally recognize that revenue is you would recognize it as you earn that subscription. So, right? So if it's 12 months, then you would recognize, for example, 12 months. Right? Or so you want to make sure that they're not recognizing the entire amount up front. And then manipulation of adjustments to revenue. So again, revenue is another example. You shouldn't see a debit in a revenue account. You shouldn't see a credit to the revenue account that's not coming from the sales journal. Right? So the audit is going to perform, assuming that controls are effective, perform tests of controls over the revenue generation, reporting process, recognition process. And part of that is looking at how that information flows to the general ledger, revenue account and the general ledger. So there shouldn't be any transactions that are not that are debited to revenue. Because what happens if a customer returns something? Where does that return? Where's that term reflected in the financial statements? Sales returns and allowance, right? Which is a contra revenue account. So therefore, why would there be a credit to revenue? If you see, and not to say that there wouldn't be, but there shouldn't be a lot of credits to revenue, and you want to look at when there is a credit, okay, assuming material. You want to look at when there is a credit to revenue. I'm sorry, debit to revenue. Some other things known as inventory fraud risk, things like fictitious inventory, purchase accounts payable, where they're understating accounts payable in order to overstate net income, right? Because you're understating the expense. And if you understate the expense, then you're overstating net income. And then things like fixed assets, payroll putting phantom people on the payroll. So those are the kinds of things that you would look out for in those other accounts. But revenue is assumed, auditors should assume that be aware of the risk of improper revenue recognition. SAS 99, similar to what we talked about with the audit risk model, the auditor has to respond to those risks. Once they identify the risks, respond to those risks by changing their audit approach, changing their, or designing and performing their audit procedures to address that risk. And look at things such as management override controls, examine journal entries. I talked about looking at estimates and biases. So again, it's once you identify where the risk is, right, then the auditor has to say, okay, well, if this is the risk of fraud, then here's the type of fraud that could occur. So here are the audit procedures that are going to address that. A related party transaction is not an arm's length transaction. What does GAAP say about So if the objective of management fraud is what? To manage your earnings, then there's no income effect, so you're not managing. I'm not saying it's not wrong, but you're not managing your earnings, right? So it's not an effect, it's an ineffect, so, and also, if someone's stealing, right, they don't, they're reporting a sale, right? They're reporting a sale below market prices. So it's still, again, how are they getting the money out? If they're stealing, how are you covering up stealing cash? Because you're selling to a related party. So the fact that you omit the disclosure information about it it's not covering up a theft. The answer is B, right? Because overstating sales revenue and overstating bad debt expense, you have a net effect of 0. And if somebody's if someone's stealing, that's what they want to come. They don't want there to be, they don't want you to be able to identify that there's a misalignment, right? You don't want that dangling debit or credit anywhere, right? So the net effect is 0. So your sales revenue is increasing, but then if you're writing off a bad debt, right? So if you're stealing money because you're getting goods out, right? You're getting goods out the door. Think about how you generate revenue. You debit accounts receivable and you credit revenue. So you're stealing. So if you're selling to a fictitious customer, if you write off the accounts receivable, you won't find it, right? Because it's written off the bad debt expense. So how do you set up an allowance, or you write it off directly to bad debt expense, right? So you've now successfully gotten inventory out, which you can sell, right? And you've written it off. You've written off the sale, or the receivable, I'm sorry. And so how am I going to detect that? How do you think the auditor might detect that? What does this scenario imply? That the person has the authority to shift inventory. Right. Separation of duties. Right? This would suggest there are no controls in this area, or very weak internal controls in this area. Right? Because that person has the ability to authorize a sale to a fictitious customer, get access to the goods being shipped to that customer, and then they can also write off accounts receivable. That's an improper segregation of duties. Ineffective controls allows that to happen. And the auditor would identify that as being a significant control weakness. And they look at, because there'll probably be a pattern here, those accounts that are being written off directly to bad debt expense and not the allowance without accounts. And it's probably a pattern. The person who's doing it is, accountability, right? So you'd identify, you can see a pattern. All right, so the correct answer is B. So, after all is said and done, the auditor evaluates the audit evidence, looking at discrepancies in the accounting records, looking at missing information that doesn't make sense. The results from their audit test, the substantive test. So during this final member, analytical procedures are required both at the planning stage and at the final stage of the audit, the completion stage of the audit. And the objective of the completion stage of the audit is to kind of take a step back and evaluate your audit evidence. So you're evaluating your audit evidence and saying, does it make sense? Given what the evidence that I've collected, now I have more information. And given that information, does this relationship make sense? Does this change make sense? Auditors are required to communicate foreign matters. We saw this with the professional skepticism case. So when Will suspected that Jess was committing a fraud, he immediately contacted the partner. Both Will and the partner reviewed the information that Will had collected. He requested that Will go back and give him some more information to confirm that what they believed was actually, actually more evidence regarding that. And then they went to management. And that's the auditor's responsibility. The auditor has to evaluate, yes, is it material? Is it going to have a material? Would it result in a material misstatement with respect to the audit, right? And if they determine that it's material, it results in a material misstatement, then they have to report that, adjust their audit opinion accordingly. Right? They would issue a qualified audit opinion. But they're not required to investigate it. Right? If they're required to investigate it to determine if there is evidence, significant evidence of fraud, then communicate that information to management. It doesn't become a forensic audit. Right? And they follow up with management and with the audit committee. That's also will probably become companies that communicated to the audit committee as well. The important thing is, no matter how immaterial a fraud is, especially if it's committed by management, they're considered to be material. So the auditor's responsibility is to communicate that to, and also they have to determine what impact that fraud could have on the financial statements, to determine whether or not it is a material misstatement as a result of the fraud. I already talked about documenting the information, therefore risk assessment. So I was going to, but we're not going to have time to go through this case in detail. So what I want you to do is I handed out this Rocky Mountain case, and what we're going to do in class on Tuesday is we're going to review the case. So make sure that you have read the case prior to coming to class, and be prepared to discuss the case in class. So I will randomly select a couple of groups to discuss the case, some aspects of the case. So make sure, and I'll communicate that to you by the end of the week. So make sure that you read the case prior to class, and we'll cover this case in class on Thursday.